G'day guys, Josh here. Well, I get this question asked a lot. What is better, a salary sacrifice into superannuation or repaying my mortgage in a strategy to overall repay your mortgage over time? Now, there's no real right or wrong answer to this because it can definitely change based on timing. Now, in particularly at the moment with higher interest rates, this question is being asked again and also being looked at more closely given the fact that interest rates are now roughly 6% on mortgages and the rate of return that you need to get in super is about 7% to make it tax efficient for the next 30 years. Now, we're going to take a deep dive in it, and we're also going to consider other options as well. Let's go through the basics. A salary sacrifice strategy is putting money into superannuation in hopes that the tax efficiency created by putting into super will have a greater long-term benefit, so when the mortgage needs to be repaid, that you can pay it up front from your superannuation. Is effectively using the lower tax rate within superannuation to build a bigger nest egg of wealth to repay at a later date. Some of these people do retire or change jobs at age 60 to access their superannuation and take out a lump sum to repay their mortgage. This can be an effective strategy for some people. However, it is subject to some risks in particular. Now, one of these risks in particular is market timing, and also in the high interest rate environments where investing in super is actually a lot less compared to repaying a mortgage or putting into an offset account. Repaying a mortgage is different. A lot of people put any spare cash into their offset account. What this does, it generates a guaranteed return against the interest rate. For example, it's currently 6%, which means you get a guaranteed 6% return after tax, which is quite huge in a lot of circumstances as well. Let's compare it to a person who owns $100,000. They're currently taxed at 32 cents in a dollar. For them to get an equivalent of a net rate of 6% return, they have to have a personal investment returning 9 or 10% per annum. And given the blue chip market space, unless you're investing in spec shares and know what you're doing, you're not going to get that sort of return on a year by year basis. So it's better off putting into the offset account where it's basically a risk-free 6% compared to a risk-on 9%. Now you may be thinking, why is this to so much debate? Because it's here to so much debate because of the returns that you potentially get, and also people's risk averseness to it as well, whether tax efficiency is worth more in the long run. To quickly evaluate both strategies, with the superannuation salary sacrifice strategy, be aware that you cannot access any of those funds until you retire. That means if you get into any health issues or anything like that, particularly where you can't work or you need help to pay the mortgage because the interest rates get too high, you can't access your superannuation until you're basically being foreclosed on. This is one of the big disadvantages to it as well, compared to an offset account where if you have the money there, you can grab it out when you need. Alternatively as well, this can be mitigated by insurance. Having a good trauma insurance or good income protection policy could mitigate this, but also at the same time, this comes with an extra cost, which may not be offset by the tax efficiency that you're trying to create. Now, secondly is market timing. When you do retire at 60, you could be retiring at a down point in the market where effectively you're impacting your retirement significantly by withdrawing the amount to repay your mortgage. It might be better to just work a bit more part-time and then repay your mortgage when the market's at a much higher stage at a later date, which could disrupt a few things as well, especially if your mortgage needs to be repaid by this date. And that is the main meat and potatoes of that sort of salary sacrifice strategy. The next one is repaying the mortgage. So a lot of people put their savings into a mortgage offset account, and that generates a risk-free return of whatever the interest rate is. If it's 6%, it generates a net interest rate return of 6%. And also you can use these funds if you get into trouble, like they say, for example, if you have a heart attack, to basically pay that. However, you need to pay that back later, but at least you saved and ignored 6% in the long run. So overall, let's just say the rate stays 6% for a year. Compared to super, you've earned a 7% rate gross return. Compared to your personal funds, you've earned a gross rate of 10% returns. Now, someone may mention gearing, and we're going to discuss that in this as well. So what is gearing? Gearing is basically borrowing to invest. And if you're borrowing to invest, this net rate or gross rate doesn't really matter, given the fact that any interest that you pay is offset against your taxable income. Unless, of course, unless you're not above the tax-free threshold, which I don't know how you got a loan in the first place. Okay, that's generally what happens there as well. To really summarize, there's really no wrong take. If you want to praise versatility and just have a safe risk-free return, you can basically repay your mortgage and put it into the offset account. If you feel like you want to look for something better, push a bit further, go about outside your comfort zone, go for the salary sacrifice strategy, okay? that's one thing up to you. Just remember when I say all of this that I do not take any of your personal circumstances to mind when talking about these strategies. This is more of a video of illustration. Please go see a financial advisor if you believe this strategy could be right for you, okay? They can ascertain it. They've got better analysis. And of course, they've got, a team of staff. They can go through this for you, whether it's actually a good thing for you or not.